Here's a shocking truth. The heartbeat of U.S. inflation is barely detectable, and it's sending ripples through the economy. But here's where it gets controversial. While some see this as a sign of weakening demand, others argue it's a strategic move by businesses absorbing tariff costs. Let's dive in. Summary. Producer Price Index, PPI, dipped 0.1% in August, defying expectations. Goods prices inched up 0.1%, while service costs eased 0.2%. Year-over-year producer prices rose 2.6%, down from July's 3.1%. In a surprising turn of events, U.S. producer prices took an unexpected dip in August, driven by shrinking margins in trade services and a modest uptick in goods costs. This suggests businesses might be quietly absorbing the brunt of import tariffs, a move that could have far-reaching implications. And this is the part most people miss. Despite these tariffs, the absence of significant price pressures hints at a deeper issue, softening domestic demand, especially as the labor market struggles to keep pace. With these economic signals flashing, the Federal Reserve is widely expected to cut interest rates by 0.25 percentage point at its upcoming policy meeting. This comes after a pause in January, when uncertainty over President Donald Trump's sweeping import tariffs left policymakers cautious. But now, the stage seems set for action. The tariff tightrope. Who's really paying the price? Christopher Rupke, chief economist at FWD Bonds, puts it bluntly. Inflation is barely breathing at the producer level, showing tariffs aren't sparking widespread price hikes yet. He raises a thought-provoking question. Could slow growth and weak demand be the real culprits keeping inflation in check? With these factors at play, a rate cut feels almost inevitable. Retailers in the hot seat. The Labor Department's latest data reveals the PPI for final demand dropped 0.1% in August, a stark contrast to July's revised 0.7% jump. Economists had predicted a 0.3% rise, but services prices fell 0.2%, led by a 1.7% plunge in trade service margins. Machinery and vehicle wholesaling margins in particular nosedived 3.9%. Stephen Stanley, chief economist at Santander U.S. Capital Markets, notes, it appears retailers have been swallowing tariff costs in recent months. This aligns with earnings reports and anecdotal evidence where firms admit they've held off on price hikes as long as possible but may soon pass costs to consumers. Bold prediction. This could be the calm before the price hike storm. Not all sectors are feeling the squeeze equally. Excluding trade, transportation, and warehousing, service costs rose 0.3%, while transportation and warehousing prices jumped 0.9%. Portfolio management fees, airline fares, and hotel room costs all saw notable increases, as did dental services. On the goods front, prices ticked up 0.1%, with food costs rising slightly. However, tariffs left their mark. Wholesale beef prices soared 6%, up 21.1% year over year. And coffee prices jumped 6.9%, 33.3% annually. Energy prices, meanwhile, dipped 0.4%. Stripping out volatile food and energy, core goods prices rose 0.3%, hinting at some tariff pass-through. The Fed's dilemma, to cut or not to cut. President Trump wasted no time seizing on the mild inflation data, urging Fed Chair Jerome Powell, whom he mockingly calls too late, to slash rates aggressively. No inflation, must lower the rate, big, right now, Trump declared on Truth Social. Wall Street reacted positively, with the S&P 500 and NASDAQ Composite hitting record highs. The dollar weakened, and Treasury yields fell. Yet, economists warn against complacency. Oren Klacken of Nationwide cautions. These PPI readings are volatile and likely reflect businesses adjusting to tariffs. The real impact will become clearer in the second half of the year. What's next? Consumer prices hold the key. All eyes are now on Thursday's consumer price data. Economists predict the Consumer Price Index CPI rose 0.3% in August, with core CPI up 0.3% for the second straight month. If confirmed, this would keep annual core CPI inflation at 3.1%. But here's the kicker. Firmer consumer inflation coupled with a weakening labor market could fuel stagflation fears. Recent data shows the economy likely created 911,000 fewer jobs than previously thought, and August's employment report revealed near-stalled job growth. Elizabeth Pencotti of Groundwork Collaborative sums it up. The Fed will likely cut rates due to the labor market's decline, but slow growth and rising prices are hitting American families hard. Final thought. Is this the calm before the storm? As businesses navigate tariffs and the Fed weighs its next move, one question lingers. Are we witnessing a temporary lull? Or is this the new normal? What do you think? Are businesses absorbing costs sustainably? Or is a price hike inevitable? Share your thoughts below. Let's spark a debate.